Hi everyone, and welcome to my insurance lecture, Replacement Costs and Coinsurance. This is going to be a two-part lecture, so you're going to have one video behind the other. My name is Rebecca, and I am your insurance lady. Now, I've gotten a lot of emails requesting that I go over some formulas that can be used to help you in your exams. So I'm going to go over replacement costs and the coinsurance formula. First, I'm going to talk about some of the ways that insurance companies evaluate property. There's different ways that property can be valued, and really I'm going to be going over the replacement cost value, but I'm also going to let you know what some of the other values are. So we all know that we get insurance to protect our assets so that if something happens to our assets, our investments are restored. So the different ways that or methods for evaluating property would be replacement cost value, which is the one that we're really going to be going over right now. But you also have the actual cash value, where the payout of your loss is going to be the depreciated value, not necessarily what you paid for the asset, but typically what it's worth today minus the depreciation. And then you have replacement cost value, which is what we were just talking about. In most cases, this is going to be better than the actual cash value because you're going to be paid what it costs to restore the asset. And then you have the market value, and this depends on the amount the asset is worth and can be sold for. And usually for older homes are going to be insured at a market value because a lot of times older homes are fully depreciated, and if they're fully depreciated under actual cash value, there wouldn't be it would be valued at nothing. So you would insure it at a market value because you want to be able to insure a home at what you can sell it for. Then you have the agreed value. This is the amount that the insurer agrees to pay for the asset, also known as a stated value. So people who insure at an agreed or stated value usually are wanting to be compensated for at least what they paid out for the asset. I see this a lot in car insurance. So if you purchased a very expensive vehicle, um, you probably want to insure it at an agreed or stated value because usually when you're insuring a vehicle, it's going to be insured at an actual cash value, also known as a depreciated value. So it depreciates every year. So you're never, if in a year or two there's damage to the vehicle and you need to get compensated for it, you're probably not going to get what you paid for it. You're probably going to get a depreciated value. So the agreed value will give you what you paid for it or what you're agreeing to insure it for. So that's one of the agreed or stated value is one of the best ways to insure property, but a lot of times it's not available for certain properties. And moving forward, we're really going to be focused on replacement cost value for this lecture. So the replacement cost value basically is the cost of replacing the property without any deduction or depreciation. If the property is valued and insured at a replacement cost value and there's a loss to the property, it would be replaced with comparable materials in order to indemnify the property. So just to hit that indemnify. Indemnify should be one of your vocabulary words. It means to restore the property or restore your asset to where it was before you suffered the loss. Now, replacement cost value is basically, again, it's what it would cost to replace, let's say, the home. Usually homes are insured at a replacement cost value, so what it would cost to replace the home with comparable materials. So if your replacement cost value on your home was worth $200,000 and you suffered a total loss for the home, let's say the entire house burnt down. If your home is being insured at a replacement cost value, then the insurance company would pay the $200,000 to replace the home with materials and all. You can insure it at a different value if you want to, but it's only going to pay out what you insured it for. So there's some instances where a person can insure a portion of their home at a replacement cost value. For example, if the replacement cost value for the home is worth $200,000, but the owner only insured it for $150,000, then the replacement cost value of the home would still be $200,000, but the amount you would get back to restore your asset in the event of a total loss would be the $150,000 that you insured it for. So in this situation, your $200,000 home was only being insured for $150,000. So $150,000 is all you get back for a total loss, meaning that the entire house was damaged. Now, what if the entire house was not damaged and you filed a claim for a part of your home? If you insured your home for less than the replacement cost of your home's worth, then you might not get the full amount needed to fix a partial loss to your home. This is where the coinsurance clause kicks in, and the formula that you'll want to know is what we'll go over on the next lecture. So go to part 2 of this. I'll go ahead and connect the lectures. That way you can get with the program on how to do the formula for the coinsurance clause and how to figure out what the coinsurance penalty is.